Asset allocation. Learn the key time-tested techniques of safe and simple wealth building. So which assets should you hold in your portfolio? This is a question that everyone should be asking, not just once in a year, but all year round. And that's what asset allocation is all about. Before we start, let me share with you this great quote. You might have heard it before, but it's worth repeating. The great investor Warren Buffett's number one rule of investing is never lose money. His number two rule is never forget rule number one. Never forget these two rules because they're so powerful. Most amateur investors focus on the upside, thinking only of the possible gains, sometimes totally ignoring the downside. You, on the other hand, should do the opposite. Focus on the downside, and the upside will take care of itself. This is what forms the foundation of investing. We call it risk management, or managing risk, the possibility of losing money. Okay, so in order to focus on managing your risk, I'll share with you one secret weapon. It's called asset allocation. We're going to describe the various asset classes that are available to you, learn why this is such a secret, and what professional investors are not sharing with you, and what you can do to improve your results 100 times. Plus, you'll also learn how one small task can improve your asset allocation. Now, there are various asset classes that are available. It might be a bit overwhelming. There's cash, bonds, precious metals, stocks, real estate, natural resources, and high-risk alternative assets like private equity and venture capital. Don't worry, you don't need to invest in all of them when you start out. You can select an asset allocation model based on your goals and your risk tolerance. But before we go on, you'll learn 3 mistakes that people make. The biggest mistake we make is having too much money invested in only 1 or 2 asset classes, like stocks or bonds. The second biggest mistake we make is having too much money in only 1 or 2 investments within an asset class. I heard a guy who invested $600,000 in Lehman Brothers just a few days before it crashed. Bad luck. The third biggest mistake is ignoring your investments when they do bad. I'm guilty of this myself. When things look bad, I don't want to look at them. No, you have to look at them. You have to learn from your experiences. Don't worry, we'll fix each and every one of these mistakes through asset allocation and other techniques such as position sizing and exit strategies. But before that, let's touch upon risk and return. You've probably heard this phrase before, high risk, high return, and that's what these graphs would probably suggest. But what people don't tell you is that managing risk, in fact, trying to reduce it as much as possible, is what makes you a successful investor. You'll soon see the safety is relative and that not all safety is created equal. The important thing to remember is nothing is ever 100% safe. The assets on the safe side at the bottom left-hand side can and do crash. Sooner or later, you'll see why. And you'll also see why you may also be the biggest threat to your own safety. Remember, safety comes from the way you manage your assets, not the assets themselves. Now, we're all about managing risk, and that's not just in a single asset class. It's across asset classes. So here's my advice. Invest across asset classes for the long term, and not just individual assets. And we'll discuss why. The asset class, i.e. the stock market, for example, has performed far better than the asset itself, like individual stocks, over the long term. I strongly believe in investing in 100-year companies, those that have the possibility of staying around for 100 years. One of the most interesting examples recently was that of Kodak and Instagram. Whilst Instagram was recently bought for $1 billion, Kodak went bankrupt. The former had just 13 employees and the latter 30,000. If you could do one thing that would improve your results in investing, it's this. Invest in an index fund. Sounds ridiculous, but that's even what Warren Buffett suggested. It's easier now than ever, especially with ETFs. Over a period of time, you can rest assured that the fees are not eating into your returns. If you do a Google search on SPIVA, that's S-P-I-V-A, you'll come across some interesting and enlightening stuff. So what can you do? I highly recommend reading this book, The Richest Man in Babylon by George Clason. It's a book that was written in the 1930s. It's a short book. You can read it within an hour or two. The message is amazing given that it was written in 1930, just before the 1932 crash and recession. And it's about asset allocation and how one man became wealthy just because of that. and how he manages debt. And basically it hinges upon three parts. The first part of your investment goes into investments like stocks or bonds, whatever. The second third goes into real estate, commercial or residential. And the third part is cash. So it's investments, real estate, and cash. It's very simple. I'll leave the links below so you can either read or hear it or even watch it on YouTube for free. But please do buy the book. It's really worth it. Now, the 50-50 rule. This is one I personally came up with. 50-50 is about enjoying your life whilst at the same time being able to take care of two essentials, today and tomorrow. The first 50% takes care of today, your bare necessities, your daily living expenses, and your essentials. The second 50 is about taking care of all other things like capital, contingency, coaching, and charity. You may say that you can't save 50% of your income. Impossible? No, it's not. If you don't believe me, send me an email today and I'll show you how you can, because saving is the beginning of wealth building. Okay, time to take action. You can watch this video as many times as you want, for as long as you want, but you need to take action if you want to transform your life. So we're going to develop a plan. But before that, you need to be aware. We have a saying, what cannot be measured cannot be managed. Right. So first of all, download the asset allocation review spreadsheet. It's available on the site just down below. Set aside 20 minutes distraction-free to review which all asset classes you have under your control. Where is your money? Okay? Enter the values in the spreadsheet and you get the percentages. Everything is about percentages. Remember that. Think in percentages, always. So what are you waiting for? Let's get started.